Welcome back to Smart Money, Smarter Moves, the show for founders, business owners, and families of wealth who want more than headlines, but to cut through the noise and focus on what really matters for their money. This week, we're doing something a little different. We're bringing you highlights from our recent ThriveTalk session featuring our Chief Investment Officer, Cain. In this conversation, Kyle shares his Q4 market insights and a forward-looking outlook into 2026, covering what he's watching in equities, interest rates, and where he sees opportunities taking shape. It's a quick, insightful listen to help you stay sharp as we close out the year and look ahead. With that, let's jump into Kyle's insights.
I'll turn it over to Kyle, who can give us that investment perspective on the past and the future.
Thanks, Peter. Yeah, you're right. It's definitely been an interesting year, to say the least. You want to go ahead and put the first slide on. So just to give you this little perspective, right? This is a longer term chart, but year to date, markets are up about 15%, which if kind of going into it, someone would have said, all right, we're going to have tariffs about 5 times higher than what we started the year with. That employment has only grown about 0.5% over the past year, which has only happened, during recessionary periods. I don't think many people would think the markets would be up 15%, but certainly after Liberation Day, the concerns of what some of those ridiculously 20 to 50% tariff rates, things have started to cool down. And ultimately, which we're talking about here in the slide, is like, what drives the markets? And, we'll circle back to its earnings. Earnings drive, at the end of the day, that's what really matters. But it's kind of a rhetoric of, I won't say like the taco trade, like Trump always backs down or chickens out, right? And that it is going to be a little bit more rational negotiations than just the blanket, what we saw on Liberation Day. But also, right, the aspect that we're going to get Fed cuts and that we're going to potentially see some deregulation, and then certainly the tax bill that was passed are going to help significantly, with the capex and R&D deductions, et cetera. So overall, the markets have continued to grind higher, and if you look, it's not just been a U.S. story for the first time in a while. I don't have the chart pulled up here, but international markets are even up better. They're about 30%. Why? Mainly because the dollar dropped, et cetera. We can get into that. Gold is up 65% today. It's not having a good day, but and what have been the sectors that have continued to do well the most? It's been still the AI trade, right? So I have this up here showing sort of the Magnificent Seven performance, back since 2020. Really started to take off kind of in the end of 2022 when ChatGPT came out, right? And that sort of was a game changer as far as all of at least what we call the hyperscalers, these magnificent performers, really ramping up, trying to be the leader in it. So, I guess I also put this slide up here to show, one, there are risks out there, and, we'll kind of talk about those risks, but the job market, tariffs. We've seen some credit defaults here recently in some of the bank earnings calls. But I think one of the biggest ones, and what I'm going to talk about first, is the AI bubble, right? And everyone's kind of hearing that as being the thing that you turn on the news, what you hear constantly. And I'll say, first and foremost, is there a bubble? And yes, there is. I'll say the answer is yes and no. Certain areas of the market are definitely frothy, right? But I will ultimately say, no, we're not done yet, right? If you look at sort of like OpenAI, it's been in the news pretty much for all of these deals lately. Again, it's the one that first came out, the ChatGPT. It's valued at like $500 billion. However, it has like $13 billion in revenues, right? It's committed almost like $1 trillion in investments. When it, again, only makes $13 billion, how's it going to fund, $1 trillion investment? So certainly there is some speculative nature to it, but this is different than the dot-com bubble dramatically for several different reasons. Ultimately, again, it goes back by earnings, and majority of the crazy amount of money that's being spent on capex, which is, absurd, it's coming from free cash flow. Amazon, Apple, they're really just doing it from free cash flow versus, taking on a lot of debt and some of the other nuanced things they did back in the tech bubble. There are a few things like Oracle, for one, is starting to borrow. We're seeing some, we call these circular deals, right? Where it's really just the top names keep paying each other for different types of things, which can overinflate valuations. But at the end of the day, I can go into more of the nuances. It doesn't look like it's anywhere close to stopping. In fact, I think if anything, some of these more creative CoreWeaves and Oracles that are starting to borrow to produce this only means that the spending system keep ramping up. So I still think we're in early innings, and that could continue. Go ahead and go to the next slide. So, again, that has led to elevated valuations. This kind of slide on the left, far left, just shows sort of the US, we're almost about 23 times earnings, which is about the highest, it's kind of at the top of that range, not quite as high as it was in 2021, but it's expensive. You look at the rest of the world, not quite as expensive as us. But I want to say, and I'm sure you've all heard this, but it's for good reason, right? The overall makeup of our markets compared to where they used to be, the return on equity on these firms are, insane. It's like 80-something% on the Mag 7, the return on equity. Their margins does warrant a significantly higher PE ratio. And then the makeup just of the S&P 500 is a lot different than it was 20 years ago. So just the, overall aspect, valuations is not a metric you really want to play as far as a short-term indicator. You don't want to say, like, hey, things are over expensive, we're going to have a pullback, because it can go on for a long time, these elevated. And I think we're in a secular market where we're going to see this be more of the norm for the long term than not. Then the last thing I want to say, sort of about the bubble concept here and valuations being stretched is like, certainly, again, when I went back to like the yes and no, could there be so much money being spent that eventually the revenues aren't there in the long run? Yes. Some companies are going to get hurt. Some companies are going to win, just like even the tech bubble and the internet bubble. Ultimately, it was a transformative, the internet was a transformative thing in society, but plenty of companies thrive. Some companies that you never heard of thrive, and some of the big companies, Cisco, et cetera, just lost 80% of the value. Again, I think we're a little bit different now, but there's still going to be similar scenarios where some companies, aren't going to be here. Other ones are going to do well. So hence diversification. I don't think it's done. You still can play the AI, but balance it out, balance it out a little bit. The last point I wanted to make about the bubble was that too, one reason not to worry about it quite yet is every time in history a bubble has popped, it's been because of rising interest rates. And we're in an environment, it's the Fed kind of taking the punch bowl away, that ultimately bursts it. We're in a period right now where we know the Fed's going to continue cutting rates. So we're just continue to have easy money. And also investor sentiment isn't extremely high. So like I said, it's still something you need to watch. You don't just throw good money after bad. But I think a lot of the froth is in the private markets more than the public markets. All right,
I'll also say, if I could just jump in really quick, a lot of my clients will tell me, oh, I was there for 2008. I was there for, the terrible things, the bubble, and I don't want that to happen again. And what we need to understand is we're not in the same generation at all in the stock market. Everything's different. So I encourage my clients not to do the compare game. That's part of the behavioral science, is try not to compare this time with times in the past, because it's just different.
Yep. And then even in 2000, 2008, right? Like, yes, there can be some extended periods where things don't work out well, but you would have made a lot of money if you had invested in 2000 and you're still holding some of those dollars today, or 2008 and you're still holding those dollars today. You still would have made significant amount of money in the markets. All right, go ahead. Next slide. All right. So
Nope.
the other, big concern I'm sure everyone's kind of heard about is the employment market, and is the economy as strong as we, expect? And if you remember, sort of Q1 of this year, GDP was actually negative for the first quarter. But again, if you look at what the reason, it was because of tariffs, right? And we imported tons of, which hurts, imports are a negative to GDP, and we imported a bunch before tariffs were in effect. So that, skewed it. You go back to Q2 now that things settled down and some of those imports cooled down. There's what, 3.8% GDP in the second quarter. In this third quarter, we've been running, the estimates that it should come in, close to that closer to 4% is what the nowcasting says. So the economy is holding up. Even though, like I said, job creation has been extremely slow. We had our first negative print. Right now, we all know that we didn't get the most recent payroll data because of the government shutdown. So we have to rely off some alternative data. But ultimately, the point is, it's certainly something to watch. I'm not saying that we're completely out of the woods. Often employment is a circular, self-reinforcing type thing, right? The more that individuals are less employed and more laid off, then they spend less, which then makes companies, lay off more. Those things can happen. However, here's kind of the silver lining is that it's not, even though it's been less growth, reason being there's been less immigration, right? So the unemployment rate hasn't gone up. The the end of the day, still the unemployment rate is extremely low compared to history. And the average income has significantly, it's like 4.8% over the past year has been the average income gain versus only about 2.7 in inflation over the past year. So individuals actually still have more purchasing power today than they did. So they are able to continue to spend. And then, like I said, we've had great GDP growth over the past year, even though we barely created any new jobs. So that means productivity is significantly higher than we previously expected. And, I don't think we can say right now that AI has been a big part of that, but it could be, right? It could have a significant trend going forward that AI can help supplement, even with slow job growth, productivity and money being made in the stock market and earnings continue to grow. Like I said, we're not out of the woods completely yet on how this is going to fold. But I think a lot of economists believe that once some of this tariff, continues, all the uncertainty sorts of move past, right? A lot of people haven't been hiring because of so much uncertainty. Once we start to get a little more certainty with how tariffs are going to look going forward, and then we get more implementation from the tax bill, impacting balance sheets. And then some deregulation coming in that and lower rates, the combination of those, a lot of economists believe that we'll start to see hiring pick back up again in 2026. Next slide. So let's talk about obviously tariffs, policy, inflation. Inflation has been stuck, at the 2.5% to 3% range for quite a while. I think a lot of individuals thought it would have been worse actually than it has been so far. You hear that out of the administration, of course. And I would say the point is, so far we haven't seen a whole lot of it through tariffs. I won't go through all the data points, but ultimately, right, the effective tariff rate currently is about 16%, but we're only seeing that it's actually being implemented around 10%. Why? Because there's mitigation strategies. They imported and stocked up on inventory, beforehand. Those things are starting to get depleted, and a lot of firms have been trying to maintain, their market share, so they've been eating some of it. Overall, we haven't seen, like I talked about, the earnings margin. The profit margin has been good so far, but it's actually made up from some of those really big mega cap stocks. If you take out kind of the Mag 7, the bottom ones have had a little bit of earnings margin hits, and that'll likely ramp up a little bit more in the second half into 2016, where we're going to start to see the inflation come through. And again, now we're in a point of, can payroll or can and wages stay compete with the inflation, or is there going to be a squeeze on the consumer and they start spending a little less or be able to afford less? But I think we all know, which kind of go ahead to the next slide here. That so far spending, even with the 3% inflation, has held up. And a lot of this has to do with what they call this K-shaped economy, right? That the lower end consumer has been squeezed, inflation, housing affordability has been rough, but the top 10% or so of earners make up about 50% of spending currently, which is about the highest in history. But their wealth effect, inflation, higher interest rates has actually been good on the wealthy. And I think I have a slide in here, which we'll go to in a minute, that shows that wealth effect. And that's been able to keep personal consumption still pretty steady. And I think that is likely to continue the way the makeup is as interest rates come down. Again, there's going to be some pros and cons from tariff hit, some cons from the tariffs, some pros from the tax bill. I think one of the themes you'll see as I go through all these slides is a lot of these things counteract each other. So it's, we're still kind of on that status quo. Even all the bad things you hear about, there are some good things offsetting it, et cetera. So, spending has continued to hold up for now. Go ahead, next slide. Yeah, this is another thing, just kind of emphasizing that point of, the top quintiles, supporting most of the spending. And you see that luxury spending still good, and then the lowers kind of, spending down, like Dollar Tree and Dollar General have actually done pretty well this year. Move to the next slide. Yep, here's just, goes in a little bit more about that wealth effect and how much wealth has actually been, trillions and trillions of dollars added that they feel comfortable continuing the spending. The next slide, I think, is a good one here to show a little bit more detail, right, of my point of how overall, even though you probably have heard things throughout the year that the consumers hurt and that student debt, now they have to start paying back their loans, and that's going to squeeze spending. And there's been so much concern about the consumer is tapped out with inflation that they can't handle anymore. And I think ultimately, this goes to show we have counteracting sort of, impact that next year, once we have the tax bill and we start to get tax refunds, that's going to be a big surge of surplus to most consumers to be able to continue. I'm not a big into consumer discretionary stocks just because of the risk and tariffs, but I've heard a few analysts suspecting that consumer discretionary should have a good year next year because they think it's actually going to be a bigger splurge in consumer spending than most is expected, because they also believe that employment's going to turn around. All right, next slide. All right, so last, a couple of things I want to leave with is, we talked about, deregulation and the job market. Another big catalyst for why the markets are continuing higher is lower rates, right? We finally got our first Fed's rate cut in September. Pretty much, baked in that later this month, we're going to get our next rate cut. The Fed produces what's called a dot plot, right? Where they, everyone on the board sort of indicates how many cuts they think is going to happen based on what they think is going to happen as far as economic data over the next year or so. So the dot plot showed 3 this year, including the one we had, 1 more next year, one more the year after that. What ultimately, it's hard to know why are they cutting, even though inflation is high. I guess the main point there is that inflation is elevated, but the main thought is, one, tariffs should be a one-time adjustment. It may gradually happen over the next year, and we may see inflation go up to even as high as 4% at some point early next year, but then it should come back down as long as expectations for inflation remained anchored. So they see the two sides of their dual mandate, employment, inflation. Inflation, if it should, the outlook going out in the future should be a one-time adjustment and then come back down. They need to start focusing on the other side of the mandate, knowing that at 4 and 4.25, where they currently are, is what they would consider restrictive. No one knows where the neutral rate is. The neutral rate is where they talk about where it's not speeding up the economy or not slowing the economy. Their estimates right now are about 3%. Again, no one really knows, but they just all right, we might as well start the adjustment to get down closer to neutral so that we're no longer at least slowing down the economy. We're still not speeding it up, is their thought. So it's not like they're cutting rates to speed up the economy. They're doing it just to have it have less of a drag, and so it doesn't hurt employment as much. So ultimately, right, that is a benefit for. Well, here's what I'll say. It's actually not as everyone just loves lower rates, right? It's good for lots of different things. It's good for equity valuation. Stock market does well because it's based on a discounted cash flow. But technically, there's been some analysis done that how much cash is out there and what individuals make off of the cash with the higher interest rates versus most debt being locked in at the low mortgage rates and not that much debt is revolving. You're actually getting a little less income than you are. But I digress. That doesn't really matter. What matters more is the environment for businesses and mortgages, right? And that is my next point, is that the 10-year drives mortgages. We know the housing market's been in a recessionary environment and basically been frozen for several years now. I think go ahead to the next slide. This shows the 10-year treasury, and that's more what mortgage rates are based off of. We're finally now, today we're at about 3.96. It doesn't necessarily follow the Fed funds rate exactly, but the trends usually do. If the Fed's cutting, the longer end could move down further. Obviously, you probably have heard things about our deficit, and there's been issues in France and Japan. And could there be a scenario where the Fed cuts rates, which actually happened last year back in September when the Fed cut rates, the 10-year rose? That could happen. I think ultimately will probably stay, that the short end will come down. The 10-year will sort of stay around this 4.2% range. It could, if it goes down to 3.6 or so, again, that's just a benefit for bondholders, a benefit for society, because mortgage rates will go down. There's more to mortgage rates, which I don't go into. So there is a possibility for mortgage rates, which are about 6.3-ish%. Even if the 10-year stays at 4, it could, and doesn't go lower, the mortgage rate could move because it's actually a higher spread than historically speaking. And again, there's things they can do with quantitative easing, et cetera, to move mortgage rates lower. So, my point being is that would be a huge benefit if we get mortgage rates down to spur the next part of the economic momentum. So we can bypass this. So last, I guess, kind of to sum it up here a little bit, right? There's plenty of good things. Consumers still spending well. Earnings have been great. Again, that's where I go back to as the main driver. We've just had 3 quarters in a row of double-digit earnings growth for Q3, which we just started. Earnings season, it's starting off great. The expectation was for about 8% earnings growth for Q3, and usually we beat it by about 5%. So this should be about the 4th quarter in a row that we have double-digit earnings growth. Expectations for next 2 years is 10 plus earnings over the next 2 years. So when you sort of put into consideration of the tax bill, lower rates, deregulation, CapEx on AI spending, which I don't think is done yet. And then, to be honest, I think that it's going to broaden out. Like part of the tariffs was to get manufacturing here in the US, and that really hasn't happened quite yet. But why? mainly it's because of the uncertainty. Certainly policies do align with the tax bill and with tariffs do incentivize more firms to start to build here. So I think the combination of those should continue to allow the equity markets to continue grinding higher. Of course there's going to be little spits of volatility, concerns about the AI. I would be a buyer. So recommendation is continue to be a buyer on dips. Obviously keep an eye out for risk. Areas I like is, again, just don't play the AI trade too concentrated. Don't just put all your money in NVIDIA. Don't do, kind of spread it around between semiconductors, software. There's other aspects that are going to benefit from that. Industrials, financials should do well from, deregulation and a steeper yield curve. The healthcares, some of the points that so you want to kind of barbell a little bit with the pure, more AI plays. And then there are other pockets that, in case those do get overvalued and have this safe, but like have some more defensive areas as well. Like healthcare is one where it's performed extremely poorly with concerns with the administration. I think now some of the fog has been lifted with, that Pfizer and some of these firms have negotiated with the administration on drug pricing. And certainly AI is a good tailway, and there's the demand there. So healthcare outside of the US, again, that's why you should always say diversify. I still like the US best, better than most of the world, but Japan, the new administration there should continue to support good governance and stocks and more stock buybacks, things like that to help their stock market. China, overall economically, there's concerns, but to be honest, their tech looks pretty attractive, whereas our tech is a lot more focused on just building. Their tech is a little bit more on doing it cost effectively and actually having more prudence, and they're cheaper. So I'm pretty optimistic on Chinese tech. On fixed income, like you said, a lot of the rate cuts have already been priced in. On the shorter end, on treasuries, so your cash that you're sitting on and you've been used to earning 5% for the past couple of years, that's going to keep going down. So I recommend sort of moving out. You don't necessarily want to go fully out to treasuries in the 10-year, just in case the 10-year does move back up. But that 5 to 7 year range, investment grade, high yield, you're not really earning too much of a spread over investment grade. And like I said, we saw a few cracks with a few bankruptcies last week. So I would, shy a little bit away from there. So mortgage-backed securities, investment grade corporates in the 5 to 7 space, diversify into some emerging market debt. I think, there's a few different areas that look pretty attractive. There's still risks on the horizon, but ultimately I'm bullish over the next year.
I just wanted to jump in. Over the last 23 years, I have a lot of clients who have the yeah buts. So when something is great, like NVIDIA or, Micron, people want to invest in it and they want to get that upside so bad because they see other people who are making a lot of money, they're concentrated. But then when the baseball hits the window and you only have one pane, meaning I only have NVIDIA because I want to ride it up, your whole window cracks, your whole window breaks. So this speaks to diversification in a huge way. We don't know what the next big thing will be. Markets are efficient. We can't time the market. So what Kyle was alluding to, not alluding to, but actually saying is diversification is the only way that you're not going to get pummeled if you only have concentrated risk. So I just think it's interesting to think back over the last 20 plus years and hear the yabbits. So don't have the yabbits.
And like the perfect example, like NVIDIA, it can continue to make tons and tons of money and do well, but based on its valuations, if it is the leader, but AMD and Broadcom, we've seen some deals pull back where, and then you have where there a lot of companies are rather using their chips, more customized chips than NVIDIA's, and their technology advancements could make AMD catch up to NVIDIA at some point in time. So it still could be like, it's not a zero-sum game that they all make money, if they don't all make money, but NVIDIA's, growth rate could slow. And because it's such a high premium, that even though it's making more money than last year, its price drops, right? And AMD catches up. And so there's, these environments that you could still be right on your analysis that NVIDIA is going to do well, but lose money in the stock. So, hence diversify, because there's always things that can happen. Correct.